I'm going to do a more detailed walkthrough of my trade from Friday. I did come into the day with a bullish bias, so I was hoping for a long position, but we opened up at 9:30 and moved up fairly quickly, not really given any opportunity for a long entry unless you would have entered down in here. I'm always hesitant to enter into a position the first 10-15 minutes of market open. I like to wait right there around the 9:50 to 10:10 time frame, or the 10 o'clock macro, as ICT calls it. So basically, we had this large run up into the macro, and then I was looking for a short position or short entry opportunity. And things that I'm keeping an eye on at market open is the regular trading hours opening gap here. So if you switch your session down at the bottom to regular trading hours, that's going to take you from the 414 candle of the previous day close to the open of the new day at 9:30, and we're just measuring out the gap between those two prices. So this is our gap. I keep an eye on that. And then the second thing that I'm looking for is first presented fair value gap. So we get our displacement up in our gap right here. I mark that out as a point of reference. And then when we make a large move up like this, and I'm looking for a short position, especially against my bias when I know that the market's been moving up as quickly as it has, I'm looking for more conservative targets on the way down. So this red line here, I've just taken my fib tool, I believe, from here to here, and then I've just marked out the 50% mark of that range. It gives me a more conservative target as far as looking for an exit position rather than trying to ride the trade all the way back down to where we started. If I had a bearish bias, I'd be more likely to look for profits down in here on the way down. But on our way up, the things that I'm watching are the swing lows. And just to walk through this, we have our high and our low, and then I'm just following this all the ways up using the wicks. And I did use a little more of a aggressive entry for this. Typically, I would be watching for a break of this swing low here because it is more prominent than this swing low. But we have these 4 failures here, and these 4 wicks failing to go higher. And then we have this push down, and this wick here breaks this low, creating a shift in market structure. Price moves back up, and then immediately it rejects. And as price is pushing down, once we clear this candle low of the previous move up, I entered into a position. That was my entry there. And what I'm watching to the left is this last series of up candles, and I'm using this as my order block. And my initial stop was above those highs. I used a fix RR for my take profit. And like I said, I entered into a position here, and we have this immediate drop. Once we cleared this more prominent swing low, I believe I moved my stop up some. But basically, what I'm looking at during all of this is this order block here. We did come above the 50% mark and close. But basically what I'm watching during this is once we pushed, basically what I'm watching for this order block, it didn't become an order block until we pushed through. So once that's been created, I don't want to see any candle closes up past the 50% mark. That would invalidate the order block. I moved my stop up slightly just to decrease my risk, but I also want to leave room in case we wick up above that 50% mark. I don't usually pull my stop clear down to the halfway point. And you see we quickly moved down, hit my take profit, hit the 50% mark of the dealing range. And when we pull back, this would have been an ideal entry if I wasn't being as aggressive. This is what I would refer to as the unicorn entry model. I don't know if it's exactly the way that ICT uses it, but basically we're lining up a order block and a fair value gap. So we had that prominent swing low that we broke through here, creating this order block and also creating a fair value gap. So we have our order block, these three up close candles. I'm just going to pull this across. And we have our displacement down, creating a sell side imbalance, fair value gap. And let's use bar replay just to make this a little easier to read. So prominent swing low, failure. We have a displacement down, creating a market structure shift. We have our bearish fair value gap here, and we have our order block here. And if you take a look at our fair value gap and you walk that back to the beginning of our order block, this wick lines up perfectly with our fair value gap. And that's what I would consider to be a unicorn entry model. So basically we're waiting for price to retrace back into this fair value gap and tap the order block. And that allows us a high probability entry, and we can place our stop loss right above the second candle of this fair value gap, and then conservative target on the way down, 50% mark. Price runs back up, taps in to our limit order that we placed there. We have minimal risk and a good risk to reward ratio. Price doesn't always line up like this, but when it does, it's typically a high probability trade. And like I said, if I hadn't entered as aggressively as I did, I probably would have waited for this setup to happen and then targeted 50% of the dealing range.